Welcome back to Investing Talk podcast. Today we're focusing our attention on a company that, well, for many people, it's become a household name for those comforting scents and little indulgences, Bath and Body Works. We're going to really get into their upcoming earnings report, try and help you filter out some of the noise and, understand what truly matters. We'll cover what analysts are thinking, how the company's done in the past, key business trends, and what the market seems to be pricing in right now. But just before we jump into all the numbers, if you're enjoying what you hear, please do hit that subscribe button, maybe give us a like, and definitely leave a comment with your thoughts. It really does help us bring more insights like this to you. And if you're feeling extra generous, well, consider buying us a coffee. The link's always right there in the description. Oh, and also, if there is a specific company you'd like us to take a look at next time, just drop us a comment below.
Yeah, it's always fascinating just how much detail goes into looking ahead at these reports. And for Bath & Body Works, there are definitely some unique factors at play this time around.
Okay, let's unpack the immediate details then. When is this report actually slated to hit? And, what are the big numbers everyone's watching?
So the main date for Bath & Body Works earnings report is August 27th, 2025. You might see August 28th mentioned somewhere too, so just keep an eye out for the final confirmation. The conference call itself, that usually kicks off at 9:00 a.m. Eastern Time. Pretty standard. Now, when we look at what analysts are expecting, the consensus, the revenue estimate is sitting right around $1.38 billion.
Okay, $1.38 billion.
And for earnings per share, the EPS, the consensus is $0.36. What's really important about that EPS number, though, is that it would actually mean a year-over-year decrease, about 2.7%.
A decrease. So analysts are expecting things to be a little bit tighter compared to last year.
Exactly. It immediately sets a bit of a cautious tone, doesn't it?
It does, and that kind of makes me wonder, you often hear about these whisper numbers, right? These unofficial figures that sometimes float around suggesting a big surprise. Is there anything like that for Bath & Body Works?
Interestingly, not really for this one. As far as we can tell, there's no compelling evidence of some materially different unofficial number out there. It seems like the market isn't really bracing for a huge beat or a huge miss based on whispers. The official consensus seems pretty solid right now.
Okay, so no big underground buzz then. What about the company itself, their own guidance? Did they set the bar high or low for this quarter?
Well, that's a key point. Management had actually guided their Q2 2025 EPS in a range of $0.332 to $0.38.
Okay.
And crucially, that range was below the street consensus at the time, which was $0.42.
Ah, right. So they guided lower than what analysts were initially thinking.
Precisely. They didn't give specific revenue guidance, just the EPS range. But guiding below the street like that, it suggests, maybe some conservatism or perhaps just a realistic view of the challenges they were seeing. That's a big factor going in.
Considering that somewhat cautious guidance, how has Bath & Body Works actually performed historically? Have they tended to beat these expectations, especially the lowered ones?
Yeah, this is where it gets interesting. Their track record over the last 4 quarters is actually quite strong. They've consistently beaten the EPS consensus. Like Q1 2025, they reported $0.49 versus $0.47 consensus. That's a 4.3% beat.
Not bad.
Go back to Q4 2024, it was even better. $2.06 versus $1.85 consensus. A really significant beat there. $0.21.
Wow.
Q3 2024. $0.48 versus $0.35. So beat by duty null 13 cents. And even Q2 2024, the comparable quarter last year, they hit $0.40 versus $0.33.
Another solid beat. So yeah, there's this pattern of consistent outperformance investors have definitely noticed.
It generally responds positively, yeah. Especially after that Q1 25 beat, analysts were talking about momentum. The typical pattern seems to be moderate volatility. A positive surprise or better guidance tends to support these brief, noticeable rallies. We haven't really seen massive, sustained breakouts, but more like a consistent positive lean when they deliver good news.
Okay, so the market rewards the beats, but maybe cautiously.
Seems that way. It suggests they're willing to reward the good news, but maybe aren't pricing in like runaway growth just yet.
Beyond just hitting the numbers, what are the underlying trends in their business? What's driving things or maybe holding them back?
Well, we've definitely seen continued innovation. That's really crucial for a brand like this, right?
Right.
Things like their Disney partnerships have been pretty visible. That, along with ramping up their digital channel investments, seems to be driving some modest sales growth. But, and this is a big but, they are facing these ongoing margin headwinds.
Okay, what kind of headwinds?
Specifically, tariffs on goods they import and just broader cost inflation are squeezing profitability. So it's this tricky balancing act.
Growing sales, but costs are biting.
Exactly. Growing the top line with new stuff, but the bottom line is under pressure. And another thing, maybe more for long-term investors, that sometimes gets missed in the headlines, is their net equity. It's still negative.
Negative net equity. Explain that a bit more. That sounds serious.
It is a significant point. Basically, it means their total liabilities, their debts, are actually higher than their total assets.
So if they sold everything, they still couldn't cover all their debts.
In theory, yes. For Bath & Body Works, it shows how much they rely on debt to operate. It really limits their financial flexibility.
How so?
Well, it makes it more sensitive to interest rate changes, for example, or if credit markets tighten up. It also means less internal cash for future growth or handling unexpected problems. It's kind of a quiet risk that careful investors watch, even if sales look good.
Gotcha. That's a really important context. So shifting to the quarter that just ended, what actually happened that might sway these results? Any big news or moves?
There were a couple of things. During the quarter, they definitely made a splash with that Disney-branded fragrance and candle collaboration.
Ah, yes, I saw some of that.
And reports suggest it wasn't just marketing fluff. It actually did give a nice boost to both online and in-store sales, added some freshness. Beyond that, they've also really accelerated their spending on digital marketing and e-commerce, trying to capture more online business, which is obviously critical today.
Makes sense. So connecting to the bigger picture, what's the vibe in specialty retail generally? And how's the economy playing into this?
Specialty retail is still, well, a bit of a mixed bag. Discretionary spending, people buying non-essentials, it's holding steady, but it's not exactly booming. Consumers are still somewhat careful.
Right.
And companies are still dealing with those higher tariffs we mentioned, hitting their sourcing costs. That's a direct hit for Bath & Body Works. Supply chains have eased up a bit, which helps, but margin pressure from different angles is still definitely there. But what's really interesting, and maybe a key thing for them, is that demand for affordable luxuries, things like Bath & Body Works products, seems quite resilient.
Affordable luxuries,
Yeah.
like small treats people still buy even when times are tough.
Exactly. Even when the economy feels uncertain, people seem willing to spend a little on small, comforting things. Sometimes they call it the lipstick effect.
Right, I've heard of that. Cut back on the big car, but still buy the nice candle.
Precisely. And Bath & Body Works is positioned perfectly for that kind of consumer behavior shift.
That's a potentially powerful tailwind for them. So, given all that, what are analysts saying overall about the company right now, heading into the report?
Most firms are sitting on moderate buy or hold ratings. It reflects that sort of balanced picture we've been talking about. The average 12-month price target does suggest potentially quite a bit of upside, maybe around 53% from current levels. And that's largely based on citing these strategic moves, like Disney and digital.
A 53% potential upside is pretty optimistic, though.
It is, but it's tempered. Many analysts are also voicing caution, pointing back to those debt levels we discussed. And there's this fundamental question. Can they keep up this recent outperformance if the broader economy takes a downturn, or if that affordable luxury demand starts to fade? So, optimism, but with caveats.
Okay, let's pivot to the stock itself. How has it been trading lately in the run-up to earnings? Any big moves?
Actually, it's been generally stable, maybe slightly positive heading into the report.
So kind of quiet.
Yeah, relatively quiet. It suggests a sort of neutral to maybe cautiously optimistic sentiment from the market. We haven't seen a huge run-up, which might signal really high expectations, nor have we seen a sharp sell-off, suggesting deep pessimism.
Interesting. Are there any specific price levels on the chart you're watching? Areas that could act as support if it falls or resistance if it rallies?
Definitely. From a technical standpoint, a key support level to watch is around $35. That's a recent low point, kind of a floor for the stock recently.
Okay, $35 on the downside.
Right. If it breaks below that convincingly, it could signal more weakness.
Yeah.
On the upside, for resistance, we're looking at $41. That's near recent highs.
$41 is the hurdle.
Exactly. A strong move above $41 could suggest a shift towards a more bullish trend.
Now, what about implied volatility? I know options traders look at this. How much of a swing is the options market actually expecting after the report comes out?
Yeah, that's always a critical piece of the puzzle. Based on the pricing of options, specifically what's called the at-the-money straddle.
Which tells us the expected move, right?
Right. It suggests the market is currently pricing in a potential move of approximately plus or minus 7%. Right after earnings.
Wow, plus or minus 7%. That's a pretty significant potential swing for one day.
It absolutely is. And for you, the listener, it raises that important question. Are you prepared for that kind of volatility? A 7% move up or down is substantial, not for the faint of heart.
Definitely something to consider. Okay, so let's try and tie all this together. Thinking about potential outcomes. What's the best case scenario here? What would a really bullish report look like?
For a truly, exactly, strong, ongoing digital growth, proof that the Disney collaboration is really adding incremental demand, that would be key. And ideally, evidence of margin expansion, showing they're controlling costs effectively or that tariff pressures are easing, that would be very positive.
Okay, that's the bull case. What about the flip side? What would trigger a bearish reaction?
A bearish scenario would probably involve a miss on that EPS number, or maybe even more damaging, weak Q3 guidance, especially if it points to more pressure on gross margins.
Margins again.
Always crucial. Also, any signs that store foot traffic is slowing down or that the digital investments aren't paying off as hoped, or just, further margin compression generally.
Mm-hmm.
And finally, if those existing worries about debt and the balance sheet suddenly feel heavier, maybe because of a worsening economic outlook, that could definitely fuel a sell-off.
Right. If you had to pick just one number, one single metric that you'll be laser focused on when this report drops, what is it?
Gross margin, absolutely crucial.
More than sales.
In this climate, arguably yes. Investors are intensely focused on cost, discipline, and profitability right now. How they manage their costs, their supply chain, how they protect those margins, that tells you so much about their operational health and their ability to handle these headwinds.
So that margin number really reveals if the growth is healthy growth.
Precisely. It tells you if it's truly profitable growth.
Okay. So bringing this all to a conclusion, what's our overall leaning here for Bath & Body Works? Neutral, bullish, bearish, and maybe a confidence score.
I'd say our overall leaning is neutral, but with a slight bullish tilt.
Okay, a cautious optimism.
Kind of. That bullish tilt really depends on them showing strong execution, especially in digital and with those brand partnerships. If I had to put a number on it, maybe a 6 out of 10 confidence level.
And the reasoning behind that 6?
Well, the company has outperformed consistently for several quarters, right? That beat streak is real. And strategic moves like Disney are adding some buzz and real growth. However, you have management's own cautious guidance for Q2 hanging out there. And those margin headwinds tariffs, inflation, they aren't going away easily.
So performing well, but facing real pressures.
Exactly. It warrants some restraint.
Makes sense. So for our listeners thinking about this, what are some high-level strategy ideas depending on their own comfort with risk?
Okay, well, for risk-averse investors, probably the most prudent thing is to wait, let the report come out, see the reaction, get some clarity.
Avoid the potential 7% swing.
Right. Given the volatility risk and that somewhat cautious guidance, just waiting might be smart. See how the dust settles. Now, for investors who are more comfortable with risk, you could look at option strategies. Things like straddles or strangles are designed to potentially profit from that big implied move, that plus or minus 7%, regardless of direction.
If you think a big move is coming.
Yeah, if you think that volatility is likely, or maybe a small speculative long position, if you really believe the market is underestimating the momentum from digital and branding, like that Disney effect.
And what about value investors, people looking for a good price?
For them, it's about monitoring for weakness after the earnings. If the stock dips, maybe because guidance disappoints slightly, but the underlying business execution, especially in those key strategic areas, still looks solid.
Then a dip could be an opportunity.
Potentially, yes. If the long-term story seems intact despite some short-term noise, a post-earnings dip could offer a compelling entry point.
Interesting. So what really stands out to you about Bath & Body Works right now, just looking ahead?
I think it's that balancing act, how they manage to keep that strong brand connection, that affordable luxury appeal, while navigating these very real cost pressures and economic uncertainties. It's a fascinating case study.
We've certainly explored a lot today around Bath & Body Works' upcoming earnings analyst views, market signals, the company's own hints. Hopefully you all feel a bit more equipped to understand the news when it lands.
Yeah, what's really compelling is seeing how a company like this, in that specific affordable luxury niche, juggles innovation-like partnerships with these persistent cost issues in such an unpredictable economy. It really drives home why you need to look beyond just the headline, EPS, and revenue numbers.
Exactly. That ongoing dance between innovation, keeping customers happy, and managing costs efficiently, that's going to be the key thing to watch for Bath & Body Works going forward. And maybe it makes you think, Just how resilient are these kinds of affordable luxuries when people tighten their belts? What could that signal for other companies in the consumer discretionary space? Something to ponder. Well, thank you for joining us on Investing Talk podcast. We hope this exploration of Bath& Body Works earnings has provided some valuable insights. Until next time, stay curious and keep learning.